Any day now, a single Supreme Court decision is set to drop, and it could send massive shockwaves through the global financial markets. We're talking about billions of dollars on the line and potential shifts in the entire economy. So let's break down exactly what could happen, and more importantly, what you need to be watching for.
Right, so how can one ruling from a court cause such a stir in the US dollar and bond markets? Well, because the outcome could directly hit everything from inflation to the perceived stability of US government debt. Today, we're going to give you the playbook, the complete guide to understanding the market's reaction, literally minute by minute as it unfolds.
To cut right through all the noise and confusion, we've broken this down into 4 very distinct paths the market could take. Think of this as your map for navigating the headlines the second that news alert hits your phone.
Okay, so what's the actual issue here? At its core, the court is deciding whether the president had the authority to impose certain import tariffs. And look, this isn't just some abstract debate over trade policy. This is about billions of dollars in real revenue and the incredibly powerful economic signals this ruling is about to send.
So here's our roadmap for today. First, Scenario A, the government wins, tariffs stay. Then we have Scenarios B and C, where the government loses, but that loss splits into 2 very different outcomes depending on the refunds. And finally, Scenario D, what if the court just delays the whole thing? Let's dive right into that first one.
First up, the most straightforward outcome of them all. The government wins its case, and the tariffs stay exactly where they are. So what does that actually mean for the markets?
Well, the logic here is pretty simple. Keeping the tariffs means continued trade friction and potentially higher prices for you and me. In other words, more inflation. And during times of global uncertainty, investors tend to run for safety, and they often find that safety in the US dollar. That strength, by the way, is measured by the DXY, the dollar index.
Now check out the 2-step reaction in the bond market. Treasury yields are basically the interest rate the government pays to borrow money. So initially, you see this flight to safety that actually pushes long-term borrowing costs down. But the market adapts fast. It starts anticipating higher inflation and future rate hikes, and that sends short-term borrowing costs shooting way up.
Okay, but what if the government loses? This is where things get a whole lot more interesting and honestly a lot more complex. The market's reaction isn't really about the loss itself. It's about the financial fallout that comes after.
So here is the absolute crux of the matter. Are we talking about a small, manageable refund that the government can easily handle? Or are we talking about a massive, retroactive payout that could seriously shock the system? That one single detail splits this outcome into 2 dramatically different scenarios.
This really lays out the 2 different paths. On one hand, you have Scenario B, a limited refund, which the market sees as great news. It signals lower inflation, smoother trade. It's what investors call a risk-on signal. But then you have Scenario C, a major refund, and that's seen as a negative. Suddenly, the focus shifts completely from trade policy over to the stability of the government's own finances.
Let's take a closer look at Scenario B. Think of this as the best-case loss. The dollar actually weakens as investors feel more confident moving into other assets. And Treasury yields fall, especially on the short end, because the market is dialing back its expectations for inflation and future rate hikes. It is a huge, clear sign of relief across the board.
Now for Scenario C, the fiscal shock. And just look at this. It is completely counterintuitive. The dollar might actually rise because global uncertainty is spiking. But the real kicker is that long-term Treasury yields, the government's borrowing costs for the long haul, jump dramatically. The market is suddenly asking, wait a minute, can the US really afford this?
So what exactly is a fiscal shock? Well, imagine the government suddenly gets a massive, unexpected credit card bill in the mail. Even if it can pay it, the sheer shock of that bill makes its lenders, the people who buy its bonds, really nervous about its financial health. So for any future borrowing, those lenders are going to demand a much higher interest rate.
All right, let's briefly touch on our 4th and final possibility. What if the court just says nothing? What happens if the ruling gets postponed?
In this case, the market doesn't really make a big bet one way or the other. Instead, what kicks in is something called an uncertainty premium. It's not about being bullish or bearish, it's simply about the cost of not knowing what's going to happen. The can just gets kicked further down the road.
Yeah, the market reaction here is pretty boring, honestly. You'd see a tiny little blip up in the dollar as a few traders hedge their bets, but overall, the market would just enter a holding pattern, waiting for the real decision to come down. This is by far the least dramatic outcome of the 4.
Okay, so we've covered all the theory. Now, let's get practical. Let's talk about your checklist for how to analyze this ruling the absolute second it's released.
Think of this as your secret decoder ring. When the decision comes out, you need to scan the text for 3 specific keywords. Refund and retroactive are pretty obvious, but also look for reliquidation. That's just a technical term for recalculating a past import tax. The presence of these words will tell you exactly which path we're headed down.
And here's why these words matter so much. If you see this kind of language used prominently and forcefully in the court's opinion, it is a massive signal that we are in scenario C territory, the scary fiscal shock scenario. These words are the telltale sign that a large-scale, backward-looking payout is on the table. But hang on, there's one last crucial factor to consider. You have to keep an eye on any statements coming from the Treasury Department. They've already signaled that they could cover potential refunds with cash they already have, which would avoid having to issue a flood of new debt. This kind of messaging could act like a firebreak, calming the market and dampening the volatility of a Scenario C outcome.
So let's put it all together one last time. This summary right here is your ultimate cheat sheet. Scenario A, dollar goes up, short-term yields go up. Scenario B, dollar goes down, all yields go down. And then the wild card, Scenario C, the dollar could pop up, but the real danger is that spike in long-term borrowing costs and a whole lot of volatility.
So there you have it. You now have the complete playbook for one of the biggest potential market-moving events of the year. The question is no longer if the market will react, but how. When that news breaks, you'll know exactly which signals matter most and what they mean for all of us.